Good afternoon. Hi, everyone. This is a webinar on Opportunity Finance Network and National Bankers Association webinar called Community Lenders and PPP, Recent Research and Implications. We apologize for the somewhat delayed start to this webinar. We were having, and still are having, a little bit of technical difficulties with our moderator. But we'd like to kick off the webinar and thank you for your patience and understanding. Next slide. So our speakers for today's webinar, we'll kind of go through them quickly. We have Mark Cassell and Mark Steinberg from Kent State University and Reed College, respectively. Anthony Barr and Carl Romer from the National Bankers Association. Myself and Brent Howe from Opportunity Finance Network. And Paul Quintero from Ascendus. And hopefully Paul will be able to join us soon. And the point of this webinar, we're going to review recent research on community lenders' participation and lending in the Paycheck Protection Program, recent research that all of us have produced, and talk about some implications. Next slide, please. So we'll go through, for each of the three groups of researchers, they'll go through their papers and highlight some key findings and implications. And then we'd like to leave at least 10 to 15 minutes at the end of the webinar to take audience questions and address those questions. So we look forward to hearing from you about your impressions of the research and questions that you have. Next slide, please. I'm going to hand it over to Mark and Mark to present their very interesting research on the Paycheck Protection Program. And they'll hop on screen and kick it off. Thank you so much, Mark and Mark.
Well, thank you so much, Adrian and OFN for inviting Mark Steinberg and me to talk about our work. We, along with our colleague, Michael Schwan from the University of Cologne, are interested in the role that bank types played in the deployment of PPP funding to under-resourced and minority communities. Next slide. We're a data-driven crew, so we conducted a quantitative analysis of how PPP loans flowed to poor and minority communities for the program as a whole, as well as over the 3 periods that correspond to the CARES Act and the 2 subsequent funding bills. We first took the 11.3 million PPP loans and coded the loans by one of 7 lender types that did the bulk of the lending in the program: top 50 derivative banks, regional banks, community banks, credit unions, farm credit associations, CDFIs, and fintechs. Next, we geocoded those loans to communities and then measured at the census tract level, where we coded for poverty and minority status. So poverty is where 20% or more of the community is poor, and minority status is where at least 50% are non-white. And we also did a number of interviews, including with folks at OFN, which was super helpful and insightful. So big shout out to OFN for their help. What's important is for us that bank types are not isolated businesses or isolated banks for that matter, but really each of the bank types represent a unique system or ecology that's grounded in a very different business model, different ownership structure, different mission, animating logics and practices. And we wanted to model the flows of PPP loans through each of those systems in ways that let us assess the sensitivities of those institutions and loan flows to whether the communities were high poverty or minority majority. Specifically, we first looked at whether lenders made any PPP loans to a business in a poor or minority community, or if they avoided those communities. And then if they were present in those communities, how many loans did they make in those communities? So here's what we found graphically. Next slide, please. The coefficient plots tell a really interesting story. The plots for each of the 7 bank types estimates the sensitivities of PPP lending to whether a community is high poverty, those are the 2 plots on the left, or majority non-white, which are the 2 plots on the right. For each bank type, you can see first how poverty or minority status impacts the odds that a lender type avoided or issued no loans to a community. Those are the 2 lower panels. The top 2 plots at the top measure how poverty and race impacted the number of loans that flowed to each lender, that flowed from each lender to those communities. In other words, assuming a bank type made at least 1 loan in a census tract, how many loans did they make? So just take, for example, the case of poverty. Those are the two graphs on the left. The bottom left plot shows 5 bank types, those are in blue, that essentially avoided making PPP loans in poor communities compared to non-poor communities. In other words, the odds of them not making a loan in those communities is very, very high. At the same time, you've got 2 bank types in red that gravitated toward those poor communities. That is, the odds of them not making a loan are very low or thin. Turning to the upper left plot, you see 2 banks in blue that stand out as making more loans in poverty communities than in non-poverty communities. The 5 banks in red made fewer loans. And the same dynamic also holds for minority status. Those are the graphs on the right. You've essentially got 2 bank types, CDFIs and fintechs, that stand out as inclusive, as actively seeking to lend in poor and minority communities. And what's interesting is not so much that both of these lender types are more inclusive. We sort of knew that. But what stands out is their influence on the inclusivity of the PPP program as a whole. And you can really see that by first just looking at the PPP loan numbers made by CDFIs. Next slide. CDFIs played a relatively small role in the first 2 rounds, but then scaled up massively in the 3rd round. CDFIs, they go from 45,000 loans in period 1 to nearly 1.3 million loans in period 3. That's a 29-fold increase in the number of loans. And the story is even more impressive when you compare the lender types over time. Next slide. Just look at the difference between period 1 and period 3. In the first period, you have conventional banks, derivative banks, regional banks, and community banks that make nearly 90%. They make 90% of all the loans in the PPP program. CDFIs and fintechs are barely visible. Now look at period 3. CDFIs and fintechs account for 48% of all loans, on par with conventional banks. And what's especially important is that this shift over time is particularly dramatic given the jump in the total number of loans across the 3 rounds. PPP loans doubled from round 1 to round 2, and then nearly doubled again to 6 million loans in round 3. Combined, fintechs and CDFIs issued about 105,300 loans in round 1. In round 3, they issue over 3 million loans. The PPP starts out as one of the most exclusive, unequal programs in US history, and then becomes one of the more inclusive programs, primarily because of CDFIs. Now, part of the reason for this is obviously the internal ability of CDFIs to scale up, to essentially respond to their customer needs, to adapt quickly to the program that was essentially being built in the air as it was being flown. That was a quote that we often heard. And we're doing research on how CDFIs responded to the PPP, how they scaled up. But another reason for CDFI's contribution is policy and policy changes. One of the things that we learned from our work, from interviews, was how important CDFIs were politically in pressing their case and their value to lawmakers, and the respondents identified at least 5 important policies that mattered. Next slide. The first is expanded eligibility for inclusive non-bank lenders. The SBA allowed non-bank lenders to participate, and they reduced non-bank prior lending requirements from 50 million to 10 million. This opened the program up to so many more CDFIs. The second policy was privileged access, set-asides and exclusive access to the web portal that was obviously the bane of so many people's existence. CDFIs had largely been excluded from participating in the first round of the program, and when they did scale up, or when they did get things in order, the money had run out. So being able to access funds from Congress and from the SBA was crucial in enabling CDFIs, to participate. A third policy was giving non-depository CDFIs access to the Fed's liquidity facilities. This was something depository institutions had always had, but it was critical for loan funds and non-depository institutions in their ability to try to scale up. Changes in the fee structure for very small loans to make lending in small amounts sustainable and attractive was the fourth policy. Lending in small amounts, as we all know, can be expensive. So that change made lending to small amounts more attractive and more sustainable CDFIs, particularly obviously in minority and poverty areas. Finally, we learned that the changes in eligibility rules to allow gross revenue to be used for Schedule C, that is, independent contractors, self-employed, sole proprietors, Schedule C filers, which predominate in poor and minority communities, was crucial. Many Schedule C firms had been closed out of rounds 1 and 2 because the eligibility was based on net profits and gross income rather than on revenue. So the takeaway from our research is really threefold. The first, when it comes to inclusivity, bank types matter. Different bank systems performed differently. Their sensitivity to the minority and poverty status of the communities varied. That's something that we learned that we didn't know. Second, we knew and we know CDFIs are focused on minority and poor communities. But you know what we didn't know? We were surprised by how important CDFIs were to the PPP and to the inclusivity of the PPP program. They scaled up quickly and magnificently. And finally, policy matters. The ability of CDFIs and their allies to organize and to press Congress and the SBA to alter the rules created the space for CDFIs to do their magic. Thanks so much, and we welcome your questions.
Thank you, Mark. So Paul, unfortunately, we're still experiencing those technical difficulties, so I appreciate everyone on the webinar's patience as I jump in this moderator role. And I also want to extend my sincere appreciation to Paul because he really helped us prepare for this webinar and pose some very interesting questions to each of the papers and each of the panelists. So I'm going to ask Paul's questions, which he gave us ahead of time. And then at the end, I'm going to ask each of the papers, each of the panelists, the questions that Paul wanted to ask. And at the end, we'll kind of combine all the audience questions and answer as many as we can. So Mark, thank you for your presentation. Paul wanted to know, how would having to evaluate credit risk or changing other elements of program design change your findings about PPP lenders, about which PPP lenders were most inclusive?
Thanks, Adrian. This is a great question. It's probably the question, actually. There's a simple answer, and there's a more useful, complicated one, I think. So I'll try to go through both of those. I think in general, we'd expect bringing credit risk and creditworthiness assessments back in would have two effects. First, it would be a reduction overall in the scale of lending across lending institutions. And second, there would be a reduction in inclusivity of lending across most, if not all, bank types, or a shift towards exclusivity. And we'd expect these shifts for two reasons. First, because of an increase in the costs of lending, the cost of underwriting creditworthiness assessment measures to protect against loss. Lots of small loans institutions can really no longer afford to make. And second, because of increasing restrictivity in lending, notably to smaller and more informal businesses that tend to predominate in poor and minority communities, especially insofar as lenders revert to relying on conventional credit scoring, which we know can bite more deeply in those communities for reasons that have maybe little to do with borrowers' decisions and characters and the like. There are two things that we didn't have time to show you that we found about the PPP that are relevant here. One, there was a shift over the program's rounds across most institutions in those reactivities or sensitivities of loan flows to communities being high poverty and majority minority. Those dots we showed you, those dots shift towards less avoidance and more loans in poor and minority tracks as we go from round one to 2 to 3. Not just you have an increase in the share of inclusive institutions, but all institutions kind of shift in that direction. They become less exclusive or even neutral or more inclusive over time as institutions learned, as they change their internal operations and routines, and as these policy changes that Mark talked about came online. The second key finding was that the main driver of those shifts over time were those small Schedule C single operator businesses and loans to them. There was a big boost in lending to minority communities in round 3, and most of those loans were Schedule C borrowers with CDFIs and fintechs leading the way. Introducing creditworthiness and credit risk assessments would likely walk most of that back, or at least part way. But it's in the howevers, there are three howevers, that things are, I think, most interesting. First, the rank ordering of institutions we showed, we don't think that would change. We think CDFIs and fintechs would still stand out as the most inclusive as a result of their different, very different combinations of missions, relationships to communities, capabilities, and cost structures. So we think the rank ordering is not going to change. Second, we think that CDFIs would almost certainly scale back more than fintechs, as they are a very different kind of lender. They're more careful in general, mindful of predatory kinds of inclusion. They work with clients to do developmental banking, what folks call technical assistance, and so on. Fintechs, with their kind of in and out transactional business models, are not burdened with that. They have automated processes and so on, and we think it better sustain scale. Of course, it's key to point out that they also aren't burdened, fintechs also aren't burdened with missions or connections to communities or regulations, so that scale and inclusivity might come with downsides of more onerous terms and leans towards predatory forms of inclusion, which I think are important to discuss. Third, and finally, and I think probably most important for this crowd, is we do not expect CDFIs to revert all the way back, especially if they can capitalize on what they gained and learned in the PPP. The CDFIs we spoke with did a lot of work on their own internal operations and their external collaborations that matter. They revised their internal underwriting routines, moved around staffing, worked on standardizing parts of their work. They experimented with technologies and portals and partial automation, in 3 cases fully automated. Third, they divided the labor of lending and technical assistance in new ways with community-based organizations and these small business development corporations and women business centers. Fourth, they forged informal learning networks among peers, consultation, and so on, as well as some formal collaborations with loan and grant programs. Standard Progress products, a shared portal in New York and Los Angeles and Pennsylvania. And finally, and critically, is something Mark touched on, CDFIs engaged in effective political mobilization and coalition building and policy advocacy and technical input to congressional leaders and staffers and so on, all to help change the rules of the game and promote some of those game-changing policy measures in ways that Mark outlined. Big lesson here about collaborative, associational, and political work. So the answer to what happens if we take away guarantees and forgiveness and bring credit risk back in, we think is not given purely by the technical issues, but we think it depends. It depends on how effectively CDFIs can capitalize on and share what they learned, those internal reforms and external collaborations and so on, and on the policy measures that mattered so much during the PPP, including especially how much CDFIs can continue to act collectively and effectively to push for focused policy changes. So that's the slightly more complicated but I think more interesting answer. Thanks.
Thank you so much for that thoughtful response, Mark. So we're going to move on to the next research presentation. Anthony and Carl, if you could come onto the Zoom screen and present your paper, Minority Depository Institutions, PPP Lending Insights. Carl and Anthony, thank you.
Thank you so much. It's good to be here. I'm going to be presenting the research that I did with Anthony Barr for the National Bankers Association Foundation, Minority Depository Institutions, Paycheck Protection Program, PPP Lending Insights. Next slide, please. So we wanted to write about the PPP lending because as the National Bankers Association, we represent minority depository institutions, and a lot of the research about PPP lending did not discuss or does not discuss the ways in which minority depository institutions lend. And so we thought it was really important to understand how minority depository institutions were leveraging PPP loans for their communities. So, we heard in the last presentation about fintech lenders and their predatory inclusion. And so some have advocated that predatory inclusion is good because minority borrowers were able to get access to loans through them. And from our perspective, we thought that minority depository institutions, because of the missions, because of the way that these institutions have connections with their communities, have obligations to those communities, that those are the institutions that are best suited to lend PPP lending. And so, yeah, so we are interested in how minority depository institutions can work with fintechs. And I think Anthony, during the Q&A period, might discuss a little bit of our work on digitalization and how minority depository institutions can work with fintechs to get loans to minority and lower and middle income communities. Next slide, please. So similarly, our analysis is of the Small Business Administration's publicly released microdata and the 11.4 million loans. Next slide. So minority depository institutions, 119 of them, collectively issued 270,000 PPP loans and more than $16 billion in loan dollars. So you'll see here in the table that the expected locations of loans is not surprising, right? So the Pacific Division, like California, Oregon, Washington, highly populated areas, similarly got a lot of loan dollars. The Southwest, Arizona, New Mexico, Phoenix is a large city, similarly got a lot of loans. What might be surprising, though, is that you'll also see the territories. So Puerto Rico, American Samoa, Guam, U.S. Virgin Islands got a lot of loans as well. And so I think a part of that stems from the fact that the minority depository institutions there are significantly larger, and we're able to leverage more of their relations with their communities as larger players in those communities. So there's something to be said that I'll get into as I'm going further into the program about the way in which investing more into minority depository institutions yields really high returns. And so that's definitely something to think about. Next slide. So most MDIs participated in PPP lending. Most MDIs of every racial group. So 94% of Native American MDIs participated, 81% of Asian American, 84% of Black, 84% of Hispanic, and 50% of multiracial. So a significant number of minority depository institutions were participating in PPP lending, but not all. And so there's room for growth as well. Next slide. So like I was saying before, not surprisingly, the largest populations in the contiguous US, or in the 50 states, I guess I should say, went to places with large populations like California, Texas, Florida, Illinois, and New York. There are some surprises even in the 50 states, however. So, if you look at Oklahoma here, what you're seeing on the map is the number of loans that went to each state. So the darker states got more loans, the lighter states got fewer loans. And so again, what's kind of surprising about this is that a state like Oklahoma, which does not have a very high population, got a significant amount of loans, and as did North Dakota. And so a part of this is the disproportionate number of American Indian or Alaska Native populations in those states. The minority depository institutions, the Native minority depository institutions, did a lot of lending in these states. Next slide. So we compared MDI lending to non-MDI lending, and to show how differently MDI lenders lent compared to non-MDIs. So we're really hoping that future research could contextualize MDIs with other mission-driven banks like CDFIs, credit unions, community banks. And so there's been a lot of research, like I said earlier, about CDFIs and community banks. And we're really hopeful that in our future research, others research, that we can do some work to compare the success rates of minority depository institutions to CDFIs and credit unions and community banks. Next slide. So when we did our research, we were just comparing minority depository institutions to all other banks. So what you see on the slide here is we're comparing minority depository institutions, where minority depository institutions lent, to non-minority depository institutions. And what you can see on the slide is that minority depository institutions deployed a greater percentage of their loans to than non-minority depository institutions, both to majority minority zip codes and lower and middle income communities. So what you see here is that disproportionately, minority depository institutions were lending to majority minority communities, whereas non-minority depository institutions were disproportionately lending to non-majority minority communities. And as well, minority depository institutions were lending to lower and middle income communities. So that's really exciting. Next slide. And further, we do the same breakdown of how minority depository institutions lent by racial group. So you can see all MDIs, Asian American, Pacific Islander minority depository institutions, Black and Hispanic minority depository institutions, and the story holds for each of these groups. So while we don't include American Indian or Alaskan Native minority depository institutions in this graph, only 15% of their loans did go to majority minority zip codes. So it seems like they are perhaps below some of their comparison minority depository institutions. This is still a remarkable feat, considering that of the 33,000 zip codes, only 1%, or around 350, are American Indian or Alaskan Native. So the fact that they were still able to produce 15% of their loans to these zip codes still speaks to the level of commitment that these institutions are making to their communities. Next slide. So the implications. Minority depository institutions have deployed dollars to at-risk communities during a time of crisis, and policymakers should explicitly design future fiscal responses to include MDIs and all mission-driven financial institutions. And we're really hopeful and excited about the future of digitalization, and are looking forward to helping minority depository institutions, CDFIs, partner with fintechs to deploy dollars to at-risk communities. Minority depository institutions were key in serving underserved communities, but they were hampered by size. We would have really liked to see more loan dollars, more PPP loan dollars be deployed by minority depository institutions, but they are, by their nature, smaller. And we are hopeful that more investment into these mission-driven institutions will help us allocate dollars where they are most needed. Next slide. And yeah. Any last questions? Yeah. Thank you so much.
Thanks so much, Carl, for that wonderful summary of your research. So Paul posed some really interesting questions about your research, and I'd like to ask one or two of those. So first, geographically, how did 5 island territories close more PPP loans than the West Coast, East Coast, and any stateside region?
Yeah, so that picks up right where Carl left off, which is the story about scale and size, right? So that finding is largely the result of a few lenders in Puerto Rico that are just particularly large and were able to push out a huge volume of lending. And I think the point here is to say, you know, your balance sheet, right? The deposits and assets that you hold determine how much you can lend. Your ability to kind of quickly deploy more loans through your infrastructure of, you know, your origination software and all of those things impacts that. And then kind of your digitalization efforts to kind of get in front of business owners and market yourself as an opportunity for them. All of that fits into having the kind of scale and size to invest resources to do that. And so I think, you know, that's one takeaway. The other takeaway I'll just say is that this is a huge success for policymakers to underscore as well, right? If you can design a fiscal response that reaches the territories in a productive and helpful way, where, you know, for example, in Puerto Rico, the poverty rate is 3 times the rate that it is, you know, on the mainland, then that's also going to be that those fiscal responses are going to be beneficial for distressed communities on the mainland too, because there's often a lot of overlaps in the challenges that those communities face.
Thanks so much, Anthony. follow-up or second question to that, MDIs clearly have a strategic moat when it comes to providing access to minority communities. How do you foresee that changing over the next couple of years as banks get out of brick and mortar businesses on the one hand, but digital marketing by fintechs and others increase on the other hand?
Yeah, so a couple of thoughts here. I'll try to keep it condensed. One is that brick and mortar continues to matter pretty substantially, and prior research from this year that we looked at found that 25% of MDI branches are in a zip code where that's the only bank present. So it's about 3 million people that live in those zip codes. And so as you think about maybe some of the larger banks pulling back their presence in communities, or shifting where their resources are, that's an opportunity for mission-driven lenders to show up and bring new branches in and make sure that they're, providing value there. And I'll just highlight, it's not just the financial services themselves, of course that matters, but think about, those institutions as employers offering quality jobs in those communities. Think about the symbolic value of having, a brick and mortar presence saying we are proud to be in this community. There's that civic pride, there's that we're going to facilitate business and development by kind of being a core stakeholder in a community. All of those things matter in a brick and mortar presence, even in a digital age. But on the digitalization side, I think, there's two parts of it. I like using the analogy of a net. So you cast a wider net with digitalization in the sense of being able to access new geographies in a way that's, more cost effective. So that's the scale portion of it. Driving down your marginal costs, making it a little bit more sustainable. Really excited, for your research, about the self-sufficiency metric that you'll talk about, because that's part of that, right? But getting to a place where you can keep the lights on as an institution by growing the amount of lending that you can do. But digitalization is also about deepening the net. And this is about, for example, setting up alternative credit underwriting opportunities where you're looking at cash flow, or you're looking at rent payments as a way of establishing ability to repay rather than just relying on a credit score or something like that. Now you're using, digitalization to enhance your ability to extend your mission and make sure that you're increasing the amount of financial inclusion that's taking place. And so I think, there's certainly heightened competition, there's consolidation, there's all of these things that are playing out in this new era of banking. But I think there's a lot of opportunity for mission-driven lenders to kind of broaden their scale and deepen their impact at the same time.
Thank you. Thanks for that thoughtful response. Okay, so next I'm going to hand it over to myself and to my colleague Brent Howell, and we're going to present our research. We'll summarize it. And so our research paper is called A View of PPP from the Inside: Financing, Financial Performance, and Operation of CDFI PPP Lenders. And it's posted on OFN's website. Next slide. So, there's been, because of its size and importance, there's been a lot of research interest in the PPP, as my co-panelists have just discussed. We kind of summarize some of that research on this slide. There's a couple key buckets. One is, this slide is definitely not exhaustive. One bucket is PPP's effect on borrowers, including like whether PPP loans improve business and financial outcomes, and whether the program's benefits outweighed its costs. There's also a lot of interest in PPP's reach, where the PPP dollars flows. So we also think, in addition to this really interesting lines of inquiry, there's also an opportunity to examine how PPP affected the boots on the ground lenders themselves, especially smaller mission-driven lenders. Next slide. So CDFIs were really prominent and targeted PPP lenders. And in fiscal year 2021, 48 OFM members reported making nearly $1.3 billion in PPP loans. So given those trends, our brief examines two research questions. First, what were the financing activities, performance, and operations of CDFIs that participated in PPP? And how did their activities and performance compare to similarly situated CDFIs? Next slide. So we do an analysis to address these research questions. We focus on those key areas that I just talked about: financing, financial performance, and efficiency in operations. We compared like two groups of small business and micro enterprise lenders. The first participated in PPP in fiscal year 2021, and the second didn't. There's 38 members, OFM members in the first group and 94 in the second. I'm going to focus on those two groups throughout the findings. So I'm going to like abbreviate and say PPP and non-PPP lenders, but you'll know what I mean. PPP lenders in those sectors. And we use our annual member survey data to address these research questions. Next slide, please. So I'm going to highlight some key findings just to whet your appetite and interest, but you'll have to read the whole paper to get more detailed information. Next slide. So first, I'm going to look at these three buckets financing first. You'll see it all on this lime green slides. So first here we look at the total dollar amount of direct financing closed, and we can see that the 38 small business and microenterprise PPP lenders closed nearly $1.7 billion in loans in 2021. In comparison, the non-PPP lenders, the 94 of them, deployed nearly or over $1.1 billion in loans. Next slide. Non-PPP lenders deployed more loans than the PPP lenders, but this is likely because there were more of them. There were 94 of them. And the average loan size differed across those two groups. So the PPP lenders had loan sizes of about $40,000, whereas non-PPP lenders' loan size was around $95,000. So the average size of 2021 PPP loans for the program writ large, according to the SBA, was $42,000. So that's on par with kind of what our members had. Next slide. This figure shows the percentage of direct financing closed in dollars by sector. And the takeaway here is that PPP lenders focused a lot of their financing activity on PPP. There was a substitution effect of sorts, right? So they were like the PPP lenders had to focus on PPP, meaning they might have taken some of their attention. It was diverted away from the loans that they typically deploy in a given fiscal year. Next slide. So on this orange slide, we kind of change bucket areas to performance measures. And here we have self-sufficiency, which measures whether a CDFI's earned revenue can cover its expenses. And PPP lenders had a much higher self-sufficiency ratio than non-PPP lenders. Secondly, we also looked at the deployment ratio, and that measures the amount of loans outstanding as a proportion of a CDFI's total capacity to lend. And deployment ratios were very similar for PPP and non-PPP lenders. And we found that somewhat surprising that these two ratios were so similar. What we didn't show on this slide is that PPP lenders experienced a much larger increase in unrestricted net assets than non-PPP lenders. And that increase in net assets will give PPP lenders flexibility to achieve future mission impact. So in our final bucket, in the operations bucket, we look at PPP lenders and non-lenders and their rates of operational efficiency. And as we can see with some of this, PPP lenders achieved high rates of operational efficiency. So the cost per loan closed was far lower for PPP lenders than non-PPP lenders. And that difference is due to the cost of administering PPP loans being lower. It's tied to the nature of this program. PPP was designed to provide a quick cash infusion to stabilize businesses, and it was a standardized product. In contrast, traditional small business lending that CDFI loan funds do requires time and energy and money for technical assistance and training. But that's the idea of capital plus, which is a core tenet of the CDFI loan fund business model. Next slide, please. Finally, we have some data on the staffing of PPP and non-PPP lenders. PPP lenders had more financing personnel on staff than non-PPP lenders. And as the chart shows, whereas the average financing FTE employee at a PPP lender closed a lower dollar amount of loans, they closed a larger number of loans compared to non-PPP lenders. Next slide, please. So just to offer some conclusions and implications, next slide. Paul posed some overarching questions about implications and what practitioners didn't know about this research or wouldn't have known ahead of time. Our answer kind of reframes Paul's question a bit. Practitioners likely knew a lot of the stuff that we found in this brief, yet we believe that it's our job to kind of document and share the experience of CDFI loan funds as economic first responders. We're interested in sharing with policymakers and CDFI partners and funders and investors how they experience the pandemic and PPP. There's some trends in the loan funds, CDFI loan funds experience with PPPs that we were able to show in this paper. Like there's a substitution effect of sorts, which I talked about earlier. We also really wanted to connect and share information across PPP and non-PPP lenders, and that's part of why we did the comparison in this paper. The two groups really experienced pandemic programs somewhat differently. And next slide, please. So what are the implications for policy and practices? CDFI loan funds can flex, right? So for many, CDFI PPP was different in nature than their typical lending products, yet they rose to the challenge. And they're a strong tool for responding to economic crises. In the short term, PPP was an essential lifeline for businesses and communities, but in the long term, we think it also will have an enduring ability to help CDFIs advance mission impact. And we also, I think there's a really important point, which my colleagues came up with. We also have evidence that CDFI loan funds successfully use tools like the PPP liquidity facility and discount window. And tools like this should be emulated for typical CDFI financing. Next slide. There's just a plug for our research page, which you should go check out after the webinar. Thank you. So I'm going to pose one question to Brent, and then we'll open it up to audience questions. So Brent, true or false? And this is questions from Paul. I know it's a little awkward that I stepped in. True or false? We have now determined the cost of closing a microloan. That's $2,000 at the PPP that the government gave for each loan closed in the PPP.
Yeah, so this is sort of related to the self-sufficiency. So I think Paul saw that PPP lenders had over 100% self-sufficiency, and the implication being that the true cost of closing a microloan is $2,000 or approximately what the closing cost for a PPP was. And I'd just like to reframe this slightly differently. I'd say we now have determined the cost of closing a PPP microloan. So I don't think that the program was as specific as sort of our targeted typical financing would be. As we've described in the brief, and you all probably understand in this audience, and all of our panelists have described, PPP was unique. It was a standard product that was designed for rapid deployment. And to be sure, CDFIs were capable and well-positioned to administer a program like PPP, and many rapidly shifted their strategies in order to administer that program. And at the same time, as I mentioned earlier, like PPP is not the typical CDFI program or strategy. So traditional small business lenders, as CDFI small business lenders and micro lenders, as Adrian mentioned, typically their lending requires a significant amount of time to prepare borrowers for underwriting through training and technical assistance. And the idea of Capital Plus is a core tenet of CDFI loan fund business models, and it's key to promoting financial inclusion. So the underwriting guidelines for small business lending to CDFIs tend to be a little bit more rigorous and less standardized than PPP underwriting for PPP lending, which provided maximum flexibility to address community needs. Or this provides maximum flexibility to address community needs. So the cost of closing a typical, if we can call any CDFI business or microloan typical, is likely much different than the cost of closing a PPP loan. That's not to say that closing cost assistance through public resources isn't welcome. It certainly is. It's just that the actual cost of closing a loan is likely different depending on the loan product, and as depending on the loan product and the credit risk analysis that CDFIs have to do in the underwriting process.
Thanks so much, Brent. Okay, so I'd like to invite all of my webinar participants to come on screen, and we'll do some Q&A from the audience. Please show yourselves again, co-panelists. And so I know I'm trying to attract some questions. I think this one is targeted or geared towards Anthony and Carl. Would you say that there were similarities in PPP lending and redlining practices, considering the differences in MDI and non-MDI lending within LMI and minority communities?
Yeah, I'm happy to take that. And, I would say, kind of two dimensions to this where the parallel to redlining might be relevant. One is the rates of disparities for borrowers who applied for PPP. So if you look at, there's good Fed data, for example, New York Fed, looking at, how likely were you to receive all the funding that you requested, for example, and there's huge disparities there between, Black businesses, for example, and white businesses, and then just, denial rates in general are elevated for minority, applicants. And so, there it's a question of, is this because of over-reliance on, credit scores, for example, as part of your evaluation of borrower worthiness, right? Because we know that there's going to be disparities that just naturally prop up when you're kind of doing it that way versus a relationship banking model that MDIs and CDFIs, bake into what they do, where it kind of takes into account a broader swath of information and making the decision about lending. So that's one portion of it. But the other portion is thinking about, who are the businesses that didn't even apply for PPP, and it's much harder to kind of quantify that and get a sense of that. But I think, there it's like, if you don't have a branch of any financial institution located in your community in the first place, or if you've had experiences in the past where you've gone and tried to get, credit and been denied, you might have just written this off completely as, this is not a program for me, or this is not something that I have eligibility for. And similarly thinking about sole proprietors, the Black barber shop, for example, where there was even a question at the beginning of the program design for PPP, like, does this apply to non-employer firms at all? And so there's an avenue of it too, where I think for me the takeaway is, we can't just expect that during a time of crisis the most distressed businesses are going to have access to lending. We need to be building those relationships in non-crisis time. We need to be making sure that there's financial inclusion that's taking place in non-crisis times, so that when those relationships are really vital and necessary during a crisis, they're already in place. And so that's something that I would point to there, and kind of connects to your point, Adrian, about what's the future of banking look like if there's even more stepping away from communities and physical branches. Then this kind of thing is even more important.
Yeah, thank you, Anthony. So oh, sure, jump in, Mark.
I want to second all of that. One of the things that Michael, and I are trying to do is track the shifting profiles of the lending over time from round one, round two, round three. I think everything Anthony said was true with multipliers in round one. In round one, loans flowed to larger employing businesses, and that often were still making money in mostly affluent white neighborhoods, and we can show that with the data. As you move across as you move to rounds two, and especially to rounds three, the profile shifts. You get many more loans flowing to minority and poor communities than you had before, and the size of those loans goes down. So those barber shops or nail salons or healthcare or landscaping businesses started getting loans in large numbers. Now, we can't assess. We know the need was well under met, but there was political mobilization inside the program to try to push back a little on the parallels between redlining and PPP in the first round, and trying to make it a little bit more inclusive as they moved on.
Thank you. So one of the audience members asked us, did we consider in our research PPP loans made with funding from other sources like CDBG or other sources? So PPP loans were made with loans from other sources. And if we had done that, if we didn't do that, would the findings be the same? Did anybody's research look at, was it all SBA data? Yes, okay. And you think the findings would have been the same if you had looked at other sources, or you're not sure?
It's really hard to know. Like I think all the researchers on this call can kind of agree that having the SBA data set fully available was, you know, a gift from heaven, right? Because typically you don't have access to all of that kind of data, you know, especially in a non kind of mortgage lending loan type. And so, you know, I would just say like it's a great question. And anecdotally, I can kind of talk about, you know, the experience of our members, for example, or things that I've heard, but I don't want to lean too far into that because I don't know how representative it would be.
Okay.
So,
Mark, go ahead. Yeah.
yeah, I would just say, I mean, one of the things that I think is really interesting about the program, the PPP program, was the way in which it basically used the private financial lending system to deploy this very important public good, right? I mean, this ability to sort of deal with the COVID recession was a policy that was implemented through a private financial system. And so, banks and lenders were essentially the gatekeepers for this program. It didn't need to necessarily be that way, but that was a feature of the program. And I think a better question might be, if we hadn't done that, if for example, there had been the opportunity, rather than use lenders as gatekeepers, that we, through the IRS or through a public agency, had simply used the tax form filings from the previous year and just essentially do what we did in the summer with individuals, namely send checks based on their filings directly to the businesses and to ask, how inclusive would that have been, or what would that have changed? I think those are questions. But I think, again, the uniqueness of the program was that it used this our private financial system to pursue this very, very public good.
Okay. Thank you, Mark. So another question I'll take, I know we have a lot more questions than we're able to get through too. And thank you for my co-panelists for answering a lot of the questions in the chat box. Check it out if you haven't looked at it yet. But so final question, do you think the impact outcomes of CDFI supporting underserved markets will convince the Fed to keep the discount window open, or so that capital access isn't an issue? Like, what do you think the implication?
Look, I'll just say, like, we hope so. I can't speak to what the Fed is or is not going to do, but it's pretty clear the benefits to CDFIs and our members through having access to the liquidity facility and the discount window. And I'd just say, like, it's an advocacy push that needs to happen.
Thanks, Brent. And Mark, did you I thought I saw your hand raised. No.
Yeah, I mean, I think that would obviously be important, but the broader question is, how are non-depository CDFIs going to be regulated? What does that look like? Depository institutions are regulated. If the access to the Fed window, I think, requires something akin to what depository institutions have. And I think the unanswered question before you get to that question is, what does that regulatory framework look like for non-depository CDFIs?
Thank you. And Mark asked, and then we'll wrap up.
Sorry, I have not a lot of experience interacting with folks at the Fed, but I could tell that they were pretty excited by technological solutions, and it would be that I think that's kind of an interesting question, and how to thread that needle, and how fintechs versus CDFIs or fintech CDFI hybrids. I think my guess is that's pretty exciting. for those folks.
Well, Mark, that was a short but thought-provoking way to end the webinar. We could dive into that for a whole nother hour, I'm sure. So we really appreciate this wonderful attendance at this webinar. Thank you so much for spending an hour of your time with us. And we encourage you to check out the research papers. Leanne posted the links in the Q&A and chat boxes. So thank you for attending, and we look forward to sharing future research like this with you. Have a good afternoon.